Okay, welcome back everyone. Just a quick sound check and then we can go on. Thanks for joining in this Friday. Just waiting for a quick sound check. Okay, sound seems to be good on my side. Again, welcome back to another OctaFX webinar. Tonight we are going to cover divergence. It'll be this morning, this afternoon, depending on where you're from. But it is evening for me. Okay, so welcome back everyone. So again, as I mentioned, we are going to talk about divergence, and you know, it's good if you have been following the past 4 weeks or so, because it kind of takes all of the skills that we have covered in the past 4 weeks. If you missed the previous 4 educational sessions, then feel free to jump back in and check it out after this session. My name is Vito Henjoto, and we can just get this started. Okay, before we begin, just a quick general advice and risk warning disclaimer. Note that any advice given is deemed to be a general advice, as the information or advice given does not take into account any particular objectives, financial situations, or needs. Therefore, at all times, you should consider the appropriateness of the advice before you act further. We do not offer signal service, managed funds, or other personalized advisory services. Please be aware of scams that promise guaranteed returns or managed accounts. And I've seen that pop up a lot. So yeah, keep that in mind. CFDs and Forex are leveraged products that carry a high level of risk and are not suitable for everyone. You can lose more than your initial deposit, so you should ensure CFD and Forex trading meets your investment objectives. Strategies and charts used in this presentation are for example only. You are reminded that past performance is not indicative of future performance. Okay, so as per usual, it is going to be an educational session, so I'm not going to take a look at whatever the market is up to today. That's left for the Wednesday session. Okay, so any requests for me to look into anything, that's not going to happen today. We are going to take a look at some practical stuff later on after we finish the slides, so follow along. And there's actually a good case study if you jumped in on the Wednesday's webinar and you know, you kind of trying to figure out what I saw, you know, that kind of says like, yeah, you know what, market could be approaching key support and resistances, might not be able to make it through. So that's part of the webinar tonight. Okay, so the agenda for tonight is we're going to talk about what is divergence, how does it happen, the different types of divergences. We have the regular divergences, and then there are a few types within the regular divergences. We're going to cover all that, as well as the hidden divergences. So what is it used for, and that's basically what we are going to follow through tonight. Okay, so what is a divergence? It is a leading indicator of price movement. It's one of the most effective signs of reversal and continuation. If you are experienced with it, you know, you used it enough to kind of figure out which one which one you should take. There obviously are other you know, criteria to kind of determine, you know, signs of reversal and continuation, but part of it's going to be divergence. It basically just indicates a decrease in price momentum. It's a warning sign that the top or bottom is near. It'll also helps you in making a decision to stay or exit a trade, and that's basically what we did on Wednesday, in terms of you know, kind of figuring out whether you should stay in that trend or you should get off that train. You know, that's basically divergence, and that's the use of divergence. Obviously, you kind of need to understand how to look at the trend, and you missed out that session, please jump into last week's session's video, you know, and get caught up in all of that. Okay, so how does it happen? We are basically looking at discrepancies or differences between price and a technical indicator. So it's basically just the indicator's failure to confirm price movement. Oscillator types, there are actually different ways in terms of looking at divergences. But the oscillator types are basically the easiest to identify divergence. That's basically the MACD, the stochastics, the RSI, and the CCI, which is pretty rare for people to use CCI nowadays. It's a commodity channels index, but for those that want to know. But in terms of popularity and usefulness, I think MACD, Stochastics, and RSI really outshines CCI. So we're going to take a look at the three main indicators there. Okay, all right, divergence. There are two different divergences that we take a look in the market, but one of the most important criteria is that the divergence needs to happen in a trend. So if the market is in a sideways market condition or a consolidation period, then divergences are not going to be reliable. Typically it doesn't work in a sideways market condition. So this is only applicable if the market is trending, and we have seen the market trend, right? We've got the euro trending down, the pound USD trending down, we've got the dollar trending up. So this is like super applicable to the current market situation. In fact, it was applicable throughout the whole week, right? We are, showing signs of divergences today. Every week during the Monday weekly outlook, I normally talk about divergences. So for those that are curious, how do you actually identify divergences by yourself? This is going to be the session, right? So we've got two basic questions when it comes to trading that you are going to ask yourself. That is, is price going to continue going up or is it going to continue going down, right? And then there's always that thought in your head, like, is this over? Is the market going to reverse? So this is like two things that might sound similar if you take a look at it, but it has two different concepts behind it. One is actually fear-driven, the other one is actually greed-driven. So if you are in a trend, right, you really want to maximize that trend, so you are definitely going to ask that question: is the market going to continue going up or is it going to continue going down? In fact, this is the two basic questions that's being asked in the market every time I do a live market session. This is basically it, right? Is it going to continue going in that direction, or is it going to reverse and stuff like that, right? It's just pretty normal. It's fear driven and greed driven, depending on your situation at that given moment. You are going to ask these two questions, right? So divergence actually gave you that answer by providing two distinct types of divergence. The first one is regular divergence, which is a reversal sign, and then we have that hidden divergence, which is a continuation sign. All right, I'm going to separate the two of them. I'm actually going to take a break in the middle when we talk about regular divergence. Then we are going to take a quick pause for Q&A if you have any questions regarding regular divergence before we move on to the hidden divergence. Because if I just ramble on and continue talking about these two different types of divergences, one after the other without a break, I think you are going to get confused, right? Okay, so let's get started with regular divergence, which is reversals in the market. So this is pretty normal, right? This is going to be this is going to answer that question, whether the trend is going to continue to go up or is it going to reverse. Is the trend going to be ending? That's basically looking for a reversal in the market. Okay, so probably not the best graphics out there, but we are looking for two signs of divergence. Basically we're looking for a bullish divergence or a bearish divergence. A bullish divergence only happen in a downtrend because we're looking for a reversal pattern. We're looking for signs of reversal, so we want to see a divergence that shows something positive in a bearish market, and then we have that bearish divergence that only happens when the market is in an uptrend. Okay, so if you take a look at this one here, what we're looking for in terms of bullish divergence is that price continues to create a lower low. The oscillators are starting to create a high low. Okay, so there are obvious different changes there. We are going to take a look at an example after this, and it'll make things a lot clearer. But in terms of bearish divergence, it's the opposite. We are looking for price to continue to create a new high, but the oscillator starts creating a lower high. Okay, so this is basically what it looks like. This is on the RSI as a divergence here, but we're looking at price that continues to go up while the RSI starts to go down, right? It starts to create a lower high. So we're looking at high in an uptrend for bearish divergence, low lows if market is in a downtrend, and we're looking for signs of reversals like this one here. So after following the bearish divergence, the market does go down, and then at the end of that move down, we are seeing signs of price continuing to create a lower low, but the RSI starts creating a higher low, right? So what it's telling you by looking at this is that price is not always correct. So we talk about this, we talk about the alphas, we talk about the betas on the first week of the session, which is exactly 4 weeks ago. So if you missed out on that, jump back in there. But I was throwing out an argument in there that, you know, the market efficient market hypothesis might not be correct, because price could sometimes mislead you. You know, it doesn't really show the sentiment. It doesn't show you changes in momentum. We're not talking about volumes here. We're talking about momentum. So volumes and momentum are two different things. So again, don't mix it up. If by this stage you are thinking, hey, you know what, I think I missed out a lot, that's okay. Continue, go on with this session, and then review the previous webinar sessions. That's on Friday. We started exactly 4 weeks ago, so it's not too far. We're not too far ahead on this one. Okay, so this is regular divergence. That's basically what you're looking for. When we talk about regular divergences, there are actually 3 different classes of regular divergence. We've got a class A regular divergence, which is the strongest divergence, and the example that I just gave you. And then we have a class B divergence, which is a weaker form of divergence. And then we have a class C, which is the weakest, and typically we just ignore it. But I'm going to explain it here just in case you come across situations like a class C divergence. What should you do? Okay, so I think identifying the different classes of regular divergence, it's key in terms of understanding whether a pullback or a correction in the market is just going to be a retracement, or is it actually going to be a reversal in the market. It's really key and important that you understand the different types of divergences, the different classes of divergences that we are going to take a look now. Okay, so you can screenshot this one if you want to, but we are going to talk about regular divergence. Class A, this is basically your main tool when it comes to divergence. When it comes to regular divergence, this is the reference point. This is what a lot of traders are looking into if they are talking about divergence. It is the strongest divergence. It's the strongest type of divergence. It's clear and easy to identify. It provides the best indication of a potential reversal in the market. It usually indicates a sharp turn in the market as well. Okay, so again, for bullish divergence class A to happen, market has to be in a downtrend, right? Again, downtrend, we're looking for a reversal sign to the upside, so it's bullish divergence, right? So price needs to continue to create a low low, right? Remember we talked about trends last week. You know, it's a lower high, lower low that constitutes a downtrend. So it has to tick that criteria where price is actually showing you a downtrend, but the oscillator starts to create a higher low, which is not in line with what price is showing you. And then the bearish divergence only happened in an uptrend, basically where price continues to create a higher high, but the oscillator starts to create a lower high. So we're not seeing the indicator, you know, really matching up with what price is doing. So that's what we talk about when we talk about divergence. We're looking at, you know, price and the oscillator diverging from one another, moving away from one another. It's not in sync anymore. So yeah, that's basically what we're looking for. We're looking for anomalies in the market that could show you signs of weakness or signs of strength, depending on what you're looking for at. Okay. So let me give you an example of a Class A bearish divergence using the MACD right now. This is on gold. This was taken about 10.5 years ago. This is an example that I took on the 29th of February 2012. Right, that's how long this material has been around for. But anyway, we see price continues to create a higher high. We can basically attach. We can draw a trend line. If it slopes up, obviously we are looking at a higher high. The MACD starts to create a lower high, right? When it comes to using MACD for divergence, it's the MACD line. It's basically what's key in there. We don't actually really need the signal line to identify divergence. The MACD does shows divergence. And MACD is actually designed to identify this divergence because MACD stands for moving average convergence divergence. Okay, right. So we got a Class A bearish divergence in a market that's moving up, right? So about 10 years ago, you look at gold prices, it is actually right around the current range that we are looking at right now. But we saw that price continues to create a higher high, then everyone jumps in thinking that, hey, you know what, it's going to continue the uptrend, but then all of a sudden the market reversed down. This is something that I actually identify with the dollar yen that we talked about last Wednesday, around 145, but we are looking at the same similar situation there. Okay, so we've got that. Again, this is a bearish divergence. Market needs to be in an uptrend, and then we saw signs of bearishness in the market identified by the oscillator failing to comply with what price is doing. Okay, so this is basically what follows through. So we've got this divergence that's on the top left there. That's the divergence that was identified. It was actually around 1750. Market crashes all the way down. Again, if you are looking at identifying divergence, make sure that it matches with the time frame that you use to analyze the market. So this, it might help if you're looking at the daily and the hourly time frame. But if you take a look at divergences on the daily and you identify a divergence on the daily chart, but you are trading on the 5 minutes or the 15 minutes time frame, it's practically going to be useless. Okay. So this is a very good example of a Class A bearish divergence. And then we've got a bullish divergence where the market is in a downtrend. It starts to create a lower low. The MACD starts creating a higher low. Okay, and obviously you see that price didn't actually go down any lower, but it's not really picking up either, right? Because divergence doesn't work like... it doesn't work instantly most of the time. It's basically showing you indications of potential changes. That changes could happen immediately, or it could come with several divergences before it reverses. This is actually one of those examples that we are going to take a look at. Okay, so the whole thing in terms of the example on the bearish divergence and the bullish divergence is actually all happening in the same time frame here. On the 4-hour time frame on gold. That's basically, we saw a divergence, a bearish divergence before the 29th of February 2012, and then we start showing signs of bullish divergence around May 2012. And in a huge trend like this one here, where it has gone on for 3 months or so, typically market takes time to reverse. It might show you 2 or 3 divergences before it picks up. So this is regular divergence. It's rather unique in a sense that it's just an indication. When we talk about hidden divergences, that's more instant and probably more applicable immediately into your trading. But when we saw regular divergences, it's a warning sign to tell you, hey, a trend might be ending. Right, it doesn't tell you that it's going to end immediately, but it's showing signs that, hey, it might end soon. So do whatever you want to do with your positions. Should you get in or should get out? Those are the questions that's going to be answered with divergence. If you're looking for a surefire way to guarantee a reversal in the market, no indicators are going to show you that. I don't think any trading strategy is going to tell you that. I mean, that's from my experience. Okay, but hey, if you believe someone has that, feel free to go there. Okay, but this is a class A divergences. So we have a bearish divergence at the top of an uptrend. We've got bullish divergences showing up at the bottom of the downtrend before it reverses up again. Okay, so very simple, very clear in terms of looking at regular divergences. Very easy to look at. Okay, next up we are talking about class B regular divergence. It is a weaker divergence. It's rarely seen and best used in combination with other analysis. Usually indicates a gradual turn in the market. So something that's a little bit slower is going to form. If the market's going to reverse slower, then it's likely going to form a class B divergence. Basically, one of the few reasons is that we might be looking at a double top or a double bottom. When we talk about double top and double bottom, we are looking at equilibrium in the market. We're looking at a significant support that's being tested or significant resistance that's being tested. So there's a lot more doubt that comes into play here. But again, we're still looking at price differences here. So bullish divergence class B again has to happen in a downtrend. Price creates a double bottom and then the oscillator starts creating a higher low. For bearish divergence, if the market is in an uptrend, it starts topping out, like it starts creating a double top, and the oscillator starts going down. That's your cue for a potential class B. Again, I'm not a huge fan of double tops or double bottoms because I think a lot of people got the idea behind double tops and double bottoms wrong, and they kind of abused it. And I'll be honest with you, in terms of getting a perfect double top or a perfect double bottom, it's really rare, and I don't like relying on double tops and double bottoms as any confirmation. So I usually skip out class B divergences, but just in case, if you saw a double top or a double bottom, just make sure that you always check for potential class B divergences. Okay. The last regular divergence, which is a class C divergence, it is the weakest divergence. It's very rare. In my 20 years of trading, basically, I only look at this situation where we have a class C divergence about maybe 2-3 times. That's basically around 2008 and then one more around 2012. It's really rare. It only occurs in a very confused, very choppy market. It's good to know, but generally discounted. I've been keeping an eye out since the pandemic happens. We haven't seen any class C divergences, at least on the daily time frame on the major currencies. We just don't see that. Okay. The difference here is not price creating a double top or a double bottom. It's actually the oscillator that creates a double top or the double bottom. Now, this is the reason why this is going to be super rare is that for price to create a double top or a double bottom, that's already hard enough. We need the oscillator to perfectly create a double top or a double bottom. That's extremely rare, so we're not looking at that. Typically, if we start looking at double tops, double bottoms, the market kind of disqualifies something in there. A double top or double bottom in an oscillator. Market disqualifies something in there because when the MACD, stochastics, or RSI starts creating double tops or double bottoms, the market is typically no longer in a trend. It's no longer trending. It's typically in a consolidation or sideways market condition. So this is the reason why it's actually really rare to identify a regular class C divergence. Okay. Okay. The oscillator types that I would recommend you guys start with are the MACD, the RSI, and the stochastics. Again, it's completely up to you. But in terms of identifying divergence, they're all going to show you different divergences, with MACD being the slowest, the RSI being the fastest, stochastics being somewhere in the middle. So the reason why we use these three oscillators is that they're easy to identify and relate to price. The MACD measures the average of price, the RSI measures the pace of change in price movement, and then we've got the stochastics. That's a little bit slower there compared to the RSI, but still faster than the MACD. Again, the other advantage that from using these three indicators is that there's a lot more traders using this, so a lot more people are going to identify with you when they look at the divergence. Okay, so we have seen the example of divergence using the MACD. That was the example that we talked about just now. So yeah, we are going to be looking at the same scenario here using stochastics. The difference is that if I switch between these two examples here, the MACD identifies one bearish divergence and then two bullish divergence at the bottom. The stochastics identify one bearish divergence and three bullish divergence at the bottom there. Okay, so the MACD is going to be slower. It's going to be it's actually going to be able to give you a much reliable divergence because it's really lagging behind, so it doesn't show you any quick immediate changes in price and then reflected as divergence. It's actually going to average a lot of stuff, so it's actually going to be slower, but it's actually going to give you a more reliable divergence. The stochastics, because it reacts a lot faster to price than the MACD, that's going to give you a lot more divergence compared to the MACD. Obviously, the RSI is going to be the fastest, but so we talk about the RSI at the beginning. So this is an example using the RSI. But if we take a look at the example here, which was taken on the 2015, we saw the stochastics, the RSI, and the MACD kind of give you the same divergence. But again, if you take a look at the length there, the MACD is going to be in the middle there in terms of how quick it's going to identify that divergence for you. The RSI is going to be more immediate. The MACD actually started a lot longer. It actually started showing signs of divergence a year before the reversal happened, but it doesn't get that confirmation until at around the same time as the RSI and the stochastics. Okay, so those are the three main differences. I would say choose one instead of overlapping three of them, because they're not going to give you divergences at the same time all the time. So it could confuse a lot of beginners out there when you're starting to learn how to identify divergences by using these oscillators, and then you have to figure out three different oscillators. I would say choose one. I'm just giving an oscillator comparison, but my preference is I use stochastics a lot more than the RSI and the MACD, depending on the situation, but I use stochastics pretty much every day. So, and I basically every morning when I look at the market, the first thing I try to identify is there any potential divergence in the market, right? The word there is potential divergence. Before it actually happened, we kind of anticipate the potential for it. That's basically it, if you make it a habit, I think it's a great thing because you get to learn a lot more, you get to use it a lot more. You use it a lot more, then you are actually able to identify which is the stronger divergence, which one doesn't really work out and stuff like that. But I would say choose one, either the stochastics, the RSI, or the MACD, depending on what your preference is or depending on your familiarity with the oscillators. Just pick one, okay? Okay, so we are taking a quick pause on divergence, on the regular divergence. We are exactly at the half-hour mark here. So any questions? Do type it in. If you're still confused about regular divergences, do type it in. In the meantime, while I'm waiting for your questions, I'm going to go through the questions here. I've got one here. What is the better RSI parameter period to detect divergence? I really don't tweak a lot in terms of RSI. I always use 14. So RSI 14 on the daily chart, it's good enough. Okay, I'm gonna go through the questions. Sounds seems to be going okay, right? Because I'm not getting any stuff here. Sounds okay, good. All right, So let me just jump in quickly and refresh your memory here in terms of an uptrend. We need the market going up, so market creates a higher high, higher low. That's basically what we're looking for a potential sign of a bearish divergence. Let me just jump in straight into the dollar yen, because this is something that we identify on the hourly time frame. During Wednesday session 2 days ago, market was quickly approaching 145. That's basically right around the time when we did the live market outlook live trading session on Wednesday. The question was, should you stay in that trend? Because if you take a look at the dollar yen, it was really trending strongly, especially this week. But notice when it starts to approach 145, and I say, look, I caution you, we are quickly approaching key resistance. That's number one. There's a psychological resistance at 145. A lot of people are going to look at 145 as a whole number and say, hey, this could be a key resistance. And it shows, because if we take a look at what price was doing, it basically continues to create a higher high. So let me just so price continues to create a higher high, right? We are looking at the highs here. It continues to go up around 45 degrees, so it's really trending strongly there. And then if you take a look at the stochastics, something is wrong, because the stochastic starts going down. It was actually down a little bit sharper. Even when it picked up, it's still down by about -5 degree. Let me bring up the RSI. So depending on the use case scenario, you could be looking at. Let me just change this. This is closed. Yep. So I don't need the RSI base MA. Okay, so if stochastics confuses you in terms of identifying divergences, then you might want to bring out the RSI, because the RSI doesn't really fluctuate. It actually reflects what price should be doing, but with price going up, the RSI starts going down, and that's basically the first sign of potential weakness in the whole dollar yen movement to the upside. We have been taking the trade up from around 138, 139. We actually started this in August at around 132. So if you have been missing out on Wednesday session, maybe jump in on those Wednesday sessions, and we actually talk a lot about this. But for those that are still wondering, what did I actually see on Wednesday to come to a potential outlook that the dollar yen might fail at 145, and it might see a little bit of the end of the current trend, at least on an intraday scale or an intra-week scale. And that's basically what happens. We have the market turning around at 145, dip about 300 pips to the downside. We are showing signs of potential pickup right now, but we'll come back here once we talk about the hidden divergence. Okay, but that's one. And then there is actually another one on the, is it the Euro USD or the Pound USD? The Euro USD actually starts showing pretty much the same thing there. Oh, that's where I say, be mindful that the trend could be ending around 99, 98.75. We have price continue to go down. We actually have stochastics starting to go up. And then obviously with RSI, it actually tells you that long before that. It started showing you at the beginning of September, and it has been doing that. Okay, so this is how we identify potential divergences. I think it's super useful if you're trading on an intraday scale, whether you are a swing trader trading within the week, or whether you are using the hourly time frame as a trend identifier, and then you jump in on 50 minutes or a 5 minute time frame, depending on how you trade. It's a very useful skill to constantly scan for potential divergence, because it might actually tell you, don't get too greedy. The trend could be ending. It might slow down. It might enter into consolidation period. It might not even reverse, right? But it might actually slow down. So I think that's the key word there. Okay. So that's regular divergence. Let me go back to the slides and see if there's any questions. AUD H1. Let me take a look at the Aussie USD on the hourly time frame. Do we have a divergence? We don't actually have a bearish divergence. If you take a look at the stochastics here, it actually creates a higher high, so that's still in line. The RSI does shows a higher high, and that's still in line with what the hourly time frame is showing you. So there's actually no regular divergence on the Aussie USD on the hourly time frame at this moment. Okay, so we go with regular divergence. We can go on with continuation patterns. Clear up your mind for a little bit, because this is actually some fine changes in the criteria. But if you kind of need to clear up, because we're looking at two different things, right? Let me summarize this. For regular divergence, regular bearish divergence, we are looking at the highs, right? We are looking at higher high in price, lower high in the oscillator. For a bullish divergence that happens in a downtrend, we're looking at, lower lows in price and a higher low in the oscillator. So we are looking at, the highs for a potential bearish divergence. We're looking at the lows for a potential bullish divergence. Okay, so let's make that clear. If I do the hidden divergence sections and then you get confused, don't worry about it. Not everyone's gonna get it straight in one go. It's always good to come back to recording and go through the material again. But it's okay if you don't get it in one go, because not a lot of people get it in one go. In terms of telling the difference between a regular divergence and a hidden divergence. Okay, so clear your minds. We're gonna go into the hidden divergence. And our hidden divergence, as I said, it's a little bit more immediate, because it's actually a trend continuation pattern, and it basically does one thing. It actually provides you with a re-entry into the current trend, the ongoing trend. Momentum will typically increase after a hidden divergence happen, and it does happen a lot during periods of consolidation or retracements. Very specifically, hidden divergences happen during when there's a formation of a chart patterns. It happens within a triangle, it happens within a flag, it happens within a pennant or a channel. You see hidden divergence when the market is actually forming a certain chart pattern. That's basically your cue there. Okay, so because it's a continuation pattern, we're looking at things a little bit differently. For a hidden bullish divergence to happen, price needs to continue to create a higher low, so it needs to maintain that uptrend, right? So price needs to continue to create a higher low. The oscillator starts creating a lower low, right? The reason why it starts creating a lower low is as it's actually starting to build up more momentum, so you can actually push higher when it starts going into a normal cycle in terms of the oscillators, right? So think about it this way: market in an uptrend, price continues to be in an uptrend. It continues to go on and create a higher low, but the oscillator starts going a little bit lower, which is really building up a little bit more room, so the oscillator can push price further to the upside, right? The opposite is true for a hidden bearish divergence. Price needs to continue to create a lower high, so it needs to maintain that downtrend, and the oscillator goes higher than price to build up more momentum. So when sellers come in, there is room in terms of momentum to push price even lower. Okay, so this is a continuation pattern. it's a completely different thing than a regular divergence. It's used in different scenarios, but when you start looking for divergences, always scan for a potential for regular divergence, and then you always scan for a potential for a hidden bearish for a hidden divergence in there. Now, as I said, with the regular divergence, we're looking at the high and the low, right? This is slightly different in terms of the lows and the highs. It's actually the opposite, right? This time around, we want to see price maintain that direction. The oscillator goes the other way to build up potential momentum. Okay, so this is something that might be considered a hidden bullish divergence. Again, this was obviously taken when the Aussie USD was above parity. It's more expensive than the US dollar. We talked about this quite recently. So this is in 2012. All right, this is where price is for the Australian dollar. If you take a look at this one here, price is in an uptrend. It creates a higher low. The momentum starts dropping down quickly while price is just really not going anywhere. That's a sign where, you know, the build up in momentum could happen, right? So that's what we're looking for in hidden divergences. Okay, so we've got typically, you know, regular divergence and hidden divergence could come one after the other. So like the example here, we've got hidden bullish divergence initially. That's showing you the first sign of a reversal in the market. The market goes up, but it starts to flatten out. Okay, and then it breaks out. So this is a very similar scenario with what we're looking at on the dollar yen and the euro USD and the pound USD this week. We've got a market that's trending, pauses, break, pauses, and then potentially break again, right? Between the two breaks, the stochastics actually clears off a lot of room. We saw the euro USD being flat. It doesn't really go anywhere. So it's maintaining a higher low in terms of price. But the stochastics, it drops down really significantly. So if you see price continues to go up or becomes flat, but the stochastics or the RSI starts going down really quickly, then we know something is wrong in there. Probably a lot of you figure this out. It's just that a lot of people don't quite understand divergence properly, so they know something's wrong with the market, but they're not able to tell what is actually going on. So after this session, you should be able to. But that's basically that. So it's okay if there's a regular divergence followed by hidden divergences. That's completely fine. So if we've got the regular divergence telling you that reversal happens, then we have that hidden divergence telling you that the trend is not over. It's likely going to continue even higher. Okay, that's basically what the market does. It doesn't go any lower, but it continues to create a higher high. Okay, so let's take a look at some useful case scenario in terms of using hidden divergences. We've got the dollar Swiss here. Basically, I identified 3 swings in there, right? We saw the first one that shows a bearish engulfing candlestick pattern on the first high. That's on the screen there. And then the second one does the same thing. But if you look at this one, we've got 1, 2, 3 times it picked up 3 times. It shows hidden bearish engulfing candlestick patterns or dark cloud cover, depending on what you want to look at. But why is it that, you know, if you short the first one, it's actually going to come back to your potential entry, or you might hit your stop loss, and then when you get out of that position, it starts going down again the second time, and then you go short again, and the market comes back again. and then you get out on the third one because you're fed up with the market, because every time you attempted to go short in the market, the market goes against you. The market goes against you 2 times. The third time you get off the market goes in the right direction. So tell me if this ever happened to you. I think this has happened to a lot of people very often, right? The moment you start saying, you know what, I don't want to short something, or I don't want to continue doing that sell in the market, and then the market just drop down significantly, but you don't actually have that position because you jump in too early. Okay, so the reason is because there's a hidden bearish divergence on the third swing, right? So we've got the first one, no divergence, the second one, no divergence, but between the second and the third high here, we've got price continuing to create lower high. The stochastics in this case starts to create a higher high, right? So it actually has more room for people to actually jump in for that short. So this is a very useful use case scenario for a hidden divergence, right? It could prevent you from going in too early, because the first turnaround in the first swing and the second swing, we just don't have enough momentum for it to break that range, right? If you take a look at the whole pattern here, it's actually forming a descending triangle, but the breakout happened on the third drop. Okay, so it could be a very useful case scenario for you guys. All right, before we go on to more of the practical sessions here, basically, I've got 3 tips here. You typically do not rely on divergence alone, because in terms of using hidden divergences, I would be looking at chart patterns as well. I'll be looking at candlestick patterns as well. There's a lot of other criterias to identifying reversals or continuations in the market. So I would say don't rely on anything alone, right? So don't rely on candlestick patterns alone. Don't rely on divergences alone. Don't rely on moving averages alone. For example, you have to build up your case, right? You kind of need to gather evidence that the market is potentially going to do something. So you need to look at a few other things to identify a key level. Okay, so you need to combine it with your trading strategy. You can use this to, hey, this is a useful tool. I'll use it as part of my daily analysis in the market. That's something that I want you to take a look at the divergence as. Okay. A divergence that occurs when the instrument is overbought or oversold has a higher significance. We have talked about correctly identifying an overbought and oversold condition. If you are still not clear on the overbought and oversold condition, jump into the video exactly 4 weeks ago. That's where we talk about the oversold and the overbought and how to read it correctly. So make sure you understand overbought and oversold before you look at point 2 on this one, because a divergence that happens during an overbought or oversold period does have a lot more significance than something that doesn't come into the overbought or the oversold region. Tip number 3, I like this a lot because hidden divergences, typically in a situation where there's a flag, there's a triangle, and there's a pattern, it's really, really awesome because you already have half of the work done by the chart patterns there. We already have some sort of guidance in terms of the sentiment in the market. We are just waiting for the right momentum for the market to break out. That's simple as that. Okay, so any questions regarding hidden divergence? Otherwise, we'll use the remainder of the 10 minutes to look at the chart. There's a question, that's a really good one from Lawrence there, a really good trick question. Can we use gold for an explanation on divergence? Technically no, because gold is not really trending. It's actually really flat. It's actually in a sideways market condition. Believe it or not, it's actually still range bound at this point in time. Neil, Global FX, exactly what happened to me on the dollar Swiss this week. And I was actually using the dollar Swiss as an example 10 years ago, right? All these charts was from 10 years ago, so can you believe it? It's how long, you know, and I still use the example because it's a really good example. It's not really easy to pick up situations like this, but it does happen to a lot of people. It's just that it's super frustrating if you come across this situation here and you actually know something is actually wrong in there, and you miss out because of, you know, probably not knowing what to look for in the market. You know, it's really frustrating. Gold is so volatile. Okay, gold is volatile. I'll tell you, gold is volatile, but we're not looking at volatility in the market. We're looking for a trend in the market to identify these divergences. Can you apply it on gold? Yes, we can. What can we use on gold? We can use this on gold. I'll try to get you some example on gold here, but as promised, I'm not gonna spill out anything. So if you're trying to get me to tell you where gold's gonna go tonight, a good one, but not gonna happen. All right, let's go to gold for a little bit. So with this one here, we do have that breakout, right? Let me just highlight this area here if we can actually see any signs of divergence in the market during that breakout. It would be a hidden bearish divergence that should be within this breakout. It's not identifiable on the daily time frame. Let's jump down one time frame lower on the 4-hourly time frame. Do we have anything on the 4-hourly time frame to identify a potential hidden divergence in gold? Yes, we do. We know gold on the 4-hourly time frame starts going down, right? Obviously, we are looking at the market creating a lower high, right? The high is lower than the previous high, and then we look at this one here. That's basically what that hidden divergence is. So again, if we take a look at the formation here, we are looking at a flex situation on gold. So let's use gold as an example if you want me to. But you're gonna find this example in the dollar yen, the pound USD, and the euro USD as well. So are we clear on being a hidden divergence? We know the market goes down, right? And then this hidden divergence happened. It tells you, you know, if you kind of reversed it, which is not ideal, you know, for those that counter whatever the market is doing in a trend like this week, you guys were in a lot of pain, and I feel sorry for you guys. But for those that follows the trend, they are pretty okay this week. In fact, it's actually one of the best weeks in the whole year. Anyway, this is how we tell that there could be that continuation to the downside, because we have a hidden divergence. Let me just type it in for you. So we've got price creating a lower high, okay, and the oscillator creates a higher high in a downtrend. Therefore, it's a hidden. Okay, so feel free to screenshot this if you want to. Maybe this is going to be a good example for a lot of you. Right? Feel free to screenshot this if you want. This is identifiable one time frame below the trend that we were looking at. So the daily time frame, we can go down to 4-hourly time frame, or we can go down to the hourly time frame, depending on your trading preference. So yeah, use whatever time frame that's suitable for you. Don't try to enforce divergences that you potentially picked up from a time frame you don't typically use, right? So if you're trading on the 50-minute time frame, trading on the hourly time frame, and then all of a sudden you want to take a look at potential divergences on the daily time frame, you're in for a lot of pain, because in terms of time scales, they are going to be different, right? You want something more immediate, therefore you stick to whatever time frame you're looking at. Okay. All right. So gold at this point in time, I don't think there's any divergences. We're looking at price continues to create a higher high, and if, as I said, you know, gold's probably not a great example. If you don't believe me that this is actually in a consolidation period, this is a market that goes flat sideways between 1695 and 1720. So it's volatile, but we're not looking at volatility. So if you misunderstood the concept of volatility, go back to the session 4 weeks ago. We talked about the difference between volatility. We talked about the difference in momentum. Volatility is not momentum. Momentum is velocity in the market. Okay, two different things. Volatility and momentum, they're not the same. Okay. Dollar Swiss still shorting. Can we have divergence for Nasdaq? We just put structure. I don't understand when people talk about structure. Maybe it's market conditions that you probably identify with. I'm probably more old-fashioned, but if you want to know the whole, typically there's only 3 market conditions there. I don't go by market structures and whatever, because I don't believe in containing the market in a certain structure. If it's a formation that, you know, it's just an uptrend, being in fancier words, I don't use that. I'm really more traditional. But if you want to have my explanations on those market conditions, you can go to the webinars, the session last Friday. Okay. All right, do we have an example on divergence on the Nasdaq? Let's take a look. Do we have potential divergence on the Nasdaq? On the hourly time frame, no, because if you take a look at the whole thing, it's technically still in a downtrend, so we cannot identify this as a regular divergence, even though it starts to be a little bit flat. It's actually flat. So this is a type B potential class B regular divergence, but it's not really regular divergence, because if you take a look at the whole picture on the Nasdaq here, this is technically still a downtrend. We cannot classify this section here as an uptrend, okay, because on the bigger scale of things, this is still within a retracement period, within a retracement range. That's actually just around 38.2% to 50%. Okay, so no identifiable divergence for you to use today on the hourly time frame. Do we have anything on the 4-hourly time frame? We don't have anything, because the stochastics, the oscillator is still up there. It cannot really be identified as a hidden divergence, as well as a potential for regular divergence. I'm just not seeing it on the 4-hourly time frame. I'm not seeing it on the daily time frame as well. So yeah. Do we have divergence on this one? See, okay, you might look at this and say, hey, you know what, this is a hidden bullish divergence, because we have price creating a lower low on the stochastics, and then price creates a higher low. Oh yeah, you know, it's in an uptrend. Hey, hold on a second here, because if we zoom out, you technically cannot call this a continuation pattern to the upside, because it's still in a downtrend. How do we know it's actually still in a downtrend? Because it's still contained by that. Okay, we don't have a higher high. If we break above that, then we might be able to identify this as a potential continuation pattern. So this is not a hidden bullish divergence. This is not that. Okay, so make sure you understand the trend first before you start looking for divergence, because if you don't understand the concept of trends correctly, and you try using divergence, I can give you a straight answer right now. You're gonna be in a lot of pain. It's really not worth it. So make sure you understand your basics very, very well. Again, if you're here but you missed out the previous 3 sessions, it's okay. You can go through those videos this weekend. Just keep in pace with whatever we're doing here. But the understanding of divergence is this: you really need to understand the momentum in the market. You really need to understand the difference between velocity and volatility in the market. You really need to be able to identify trends quickly in the market. If you don't understand an uptrend, or you don't understand the key terms for downtrends, or which market is actually a sideways market condition, don't attempt to use divergences, because it's really gonna screw it up, right? It's really gonna mess you up. So if you want to use divergence, use it correctly, because if you randomly look at things without context, that's actually really dangerous, and that's where a lot of people mess up in their trading, because they don't really build up a strong foundation. So someone was asking, I'm new here, I need mentorship, what to begin with and stuff like that. I would say, go through the three previous videos that we've done every Fridays, right? We are going to do a session again next Friday on educations. So yeah, what I want to say for those that just jump in and start trading, I would say, really build up your basics really well. Form your fundamentals in technical analysis really, really well before you go on and learn about other indicators or chart patterns or candlestick patterns, which is really going to be useless to you if you don't understand the basic. If you cannot draw a proper trend line, if you cannot identify an uptrend or downtrend or sideways market condition, any indicators, any strategies is going to be useless to you if you don't understand the basics, right? So I would say focus on your basics first, and then figure out other tools. But we're going to do that progressively, okay? Slowly. We're going to build that up. I believe we have this webinar series for the next 2 more months, I believe. So there's still a lot to cover, right? So really get your basics strong right now. If you're watching this on a later date, just take a look at the date this video is being posted on, and then go through it. We started exactly 4 weeks ago. So this is webinar number 4 actually. So yeah, not too far ahead. What is volatility? Very good question. Merci Daniel. Go back to the video exactly 4 weeks ago. Okay. That, I spent an hour and a half talking about momentum, volatility, velocity, alphas, beta, systematic risk, right? Efficient market hypothesis. We covered all that in the first week before we even go on to any charts and stuff like that. The Euro USD on the hourly time frame, does it count as a bearish divergence? Let's take a look at Euro USD on the hourly time frame. Does it count as a bearish divergence? It doesn't count as a bearish divergence because the RSI actually doesn't pick it up, right? Still higher high, slightly lower high. The RSI though is completely fine. It's completely perfect. It's still in line with price. Okay. How much can you start with trading? It really depends. You can start small, but don't aim too wildly if you're starting small. What I'm trying to say is use context, use logic. If you start with $100, you can start with $100. If you start with 1,000, you can start with 1,000. But don't assume that you can turn $100 into 10,000 in 1 month or 2. That's way off, right? A scammer would say that to you, but if you take this seriously, you need some sort of logic in there to kind of temper your expectations a little bit, right? Especially when you just started trading, you're not gonna get that skill immediately. So, okay, you can start small to experiment, to actually get used to executing trades or stuff like that, or you can use a demo account if you want to. Okay, but I would say really understand the market first, really understand what you're doing here before you attempt to trade on a bigger lots, right? I know a lot of people are tempted with starting small and then trade with bigger lot size, and then they're thinking like, hey, you know what, if I start with 100, I trade a standard lot size, you know, I could quickly gain. But leverage goes both ways. It would help with your gains. It will also help with your lot. Sorry, it will also go against you when you are in the wrong position. So don't trade like that. In terms of how small you want to trade with, completely up to you. Whatever you're comfortable with. That's what I would say to people that starts out. If you're not comfortable with something, don't. Simple as that. If you really need to use that fund for you to, you know, go about living every day, I would say don't use that fund. If you want to start trading or investing, it's always a fund that you're comfortable losing. Simple as that, because it takes away some of the mental burden when it comes to trading or investing. Start with 100 trade with 0.1 lot. That's, yeah, I mean, a lot of people think about it that way, but I say probably not. The logic that I always use, we're going to talk about this in risk management about week 12. There's actually a ratio to do this, but always divide 1000 by whatever you're trading with. That's what your maximum lot size is. Okay. All right, we're getting a little bit off topic here, but any questions regarding divergences? I'm gonna leave it to the chat for a bit. In which episode we can understand better on market trending? Last week's session. This is number 4. It would be episode 3, which is last week. So jump into last week. It's really more practical. It's really fun. Just jump in. Just check it out. We talk about, I think the title is actually market conditions. So yeah, just search that on YouTube. It's actually last week's. If you want to go through the video list, you go through it. It's last week's sessions, market conditions. Dollar yen, is it possible to buy it long? You know what, Ronnie, I'll answer this for you. Just one, and then we can wrap it up. Dollar yen, in terms of the whole outlook on the whole dollar yen here, there are a couple of cautions, but if you take a look at how quickly the 4-hourly time frame drops down, this is probably a good example, right? Actually, I'm gonna throw it out to you out there. What is the potential scenario with the dollar yen as it is right now? What do you think you see in the dollar yen? It's trending up, right? So let's type it in if we want to take a look at this. Dollar yen, despite the correction that's about 300 pips to the downside ever since Wednesday, still is in an uptrend. So I'm going to move it aside. Take a look at the whole situation here. What could likely happen here? All right, are we looking for a potential for a regular divergence, or are we looking for a potential hidden divergence here? I find beginner can start with Euro Pound, which is the movement is slower and more predictable. I would say beginners stay away from Euro Pound. For those that didn't know about Euro Pound, it actually doubles your positions. All right, so beginners actually stay away from Euro Pound. Small range like that, it's actually really dangerous if you're a beginner and you're stuck with a range bound market condition most of the time. So just be careful. Right, so dollar yen is still in an uptrend. it creates a higher low in price, lower low in oscillator. Right, what do you think is likely or could happen here with the dollar yen? So, okay, so let's take a look at this one here. What could potentially happen with the dollar yen? Again, this is on the 40 time frame. This is not going to happen instantly, but that could be a little bit of an indication of what this could mean. And also where price bounces off right now, you know, it is at 142, which was the target we were aiming for this week. Right? No takes on this one? Okay, nothing? Okay, that's boring. Potential for hidden bullish divergence, which is a continuation of the current trend. Right, continuation. Correct. Continuation to the upside, yes. Do we use default settings on both our RSI and oscillator to get good divergence confirmation? Hidden bullish, yes. It is a hidden bullish divergence. To start with, for those that are new to using oscillators, I would say stick with this standard settings. But my stochastics are a little bit different. I'm using 14.55. For RSI, I use 14. MACD, I wouldn't change the thing. 26, 12, 9. So yeah. Okay, so we got a hidden bullish potential for potential because it could go either way. We don't have a cross. For this to be confirmed, we need the stochastics to cross up. Okay, but let's check on the hourly time frame. Do we have any similar scenario here? We actually do. We are actually looking at a really similar situation here where we actually have a lower low in stochastics and a higher low in price, right? So if it does reverse to the upside, obviously you need to wait for something because we're not really off yet. There are a few confirmations that we need to take a look on this one here. Ideally, I want to see price goes above 143, 144, right? But market is showing signs of possible continuation. That's what we can deduce from the current situation. Just for your disclaimer, I do not trade on Fridays, and I haven't been trading Fridays for the past 15 years. If you think today is volatile, where have you been the past week? Okay. No more trick questions. I'm not going to be answering anything about markets. If you want to ask me stuff about markets, come in on Wednesday about the same time. That's my session when I talk about what's going on in the market, right? Either that or the Monday's market outlook. But if you want to ask anything live about the market, do so on Wednesday. That's my session. I'll be more than happy to answer those during those sessions. Why do I avoid Fridays? Okay, I actually avoid 2 days. So I'll share a little bit, and then we can wrap it up. I avoid Monday and I avoid Fridays. The reason why I avoid Mondays is because the US market is not open yet. It could reverse whatever the Asian session or the European session does when the US market kicks in. Okay, I don't trade Friday. I don't trade Friday when the US when the UK market close. I stop trading on Friday. Typically, when the US market starts, I'm already gone. I am predominantly a European UK session trader, right? I don't trade the Asian session. I don't really trade the US session much. I open my positions in during the UK or Euro sessions, and I adjust it during the US sessions. The reason why I don't trade on Fridays is that there's actually a lack of liquidity on Fridays and on Mondays. Okay, there's no overlapping market. The Asian session closed earlier, and then we lose a lot of traders when the US session kicks in. Maybe there's about an hour or two with an overlap with the European session and the UK session, but that's the end of the day for them. They're adjusting their positions, they're wrapping up the positions. So to me, Mondays and Fridays, there's a lot of uncertainty for my kind of trading because I'm typically more of a swing trader. I don't trade within the day, I trade to open a position within the week. So that's why I avoid Mondays because there's a lack of uncertainty. On Fridays, I avoid Fridays because there's a lack of liquidity. Got it. But that's my view, right? Everyone's going to be different. Okay, so it looks like we can wrap it up for today. Thanks for joining in. Don't forget to click subscribe. And then click the notification icon so you don't miss next week's session. If you watch this on a later date and you've been missing out, look at the date this video is uploaded. Go back 4 weeks. That's the beginning of our series. That's where you want to get started if you are a beginner in trading. Okay. Other than that, have a great weekend. Stay safe, and I'll see you next week.